Hello, everyone. Thank you for joining us today. My name is David Judas, and I head up the Intermediary Sales and National Accounts team here at Barron Capital. The purpose of today's Thought Leadership Forum is to give you an educational overview of the opportunity that we see in India, with the goal of helping you to help your clients as you consider your portfolio allocations. Leading our discussion today is my colleague Anuj Agrawal, portfolio manager of the Barron India Fund, BINDX, which was recently converted from the Barron New Asia Fund on September 1st. Anuj has 15 years of investment experience, 12 of which here at Barron Capital covering India. Having graduated from MIT and Columbia, I can assure you he's not only a nice guy and a great colleague, but he's a very smart guy as well. Anuj grew up in India and has deep connections and deep relationships there, and is ideally situated to manage this fund and help us all learn more about the opportunity in this rising asset class. To kick off our discussion is Michael Cass. Hey, Michael. Portfolio manager of the Barron Emerging Markets Fund, BEXIX, and the Barron International Growth Fund, BINIX. India is currently our largest holding in the Emerging Markets Fund, and Anuj has worked very closely with Michael, as an analyst and assistant portfolio manager on the Barron Emerging Markets Fund. Michael and Anuj represent the 43-member Barron Research Team, which is the intellectual capital engine and the true competitive advantage here at Barron Capital behind our alpha generation capabilities. We'll be taking questions, and thank you for the long queue already. But please, if you have a question, we encourage you to submit it in the portal under the chat, or you can email it to questions@barronfunds.com. A few disclosures on the screen before we start. And with that, I'm going to begin today's webinar by asking Michael to get us started, please. Michael.
Thank you. Thanks, Dave. So there's really two reasons that we're launching the Barron India Fund now. The first, I think we've expressed over several years our enthusiasm towards the investment opportunity in India. I think many investors appreciate India's superior demographics, structural growth, their embrace of capitalism, the vibrant entrepreneurial community there. All of that is what makes India particularly well aligned with the Barron investment discipline and why we've had such a large exposure there for many years. But in recent years, both a series of impressive productivity enhancing reforms and geopolitical developments have really added to India's appeal, and in our view, is really extending the duration and the visibility of the investment opportunity and growth opportunity in India. We believe we're seeing a rise of a new asset class, and we at Barron believe that warrants a dedicated fund. I might add that we think India is destined to become the anchor weight within the EM asset class as well. The second reason we're launching now is that we feel Barron has a great asset and a competitive advantage in Anuj. He spent the past 12 years by my side. I've watched him evolve from research analyst to a proven EM stock picker to an assistant portfolio manager, and now I believe he'll be a very successful PM of our dedicated India strategy. Anuj has developed an impressive network of contacts and relationships. He conducts multiple research trips in India on the ground every year. And in recent years, he's really taken the lead on developing themes and bottom-up investment ideas in India in his capacity as the APM of the emerging market strategy. I want to stress that there's going to be no change to the EM or international strategies or how the team interacts and operates. We simply are going to have an India-only vehicle in addition to having a large India weight within the EM fund. And Anuj will continue in his role as APM of that strategy. And with that, I'm delighted to turn it over to Anuj, who's going to walk us through a deep dive on India and where we see the greatest opportunities there.
Thanks, Michael. So let me begin by saying a big thank you to the audience, that's with us today. And I believe we've got over 200 attendees today. So thank you for your show, strong support and interest in India. So let me get started. Michael and I joke internally that India's been the best kept secret from allocators. And I'm sure many, if not most of you, this is going to come as a surprise to you, that India's been the best performing market in the world over the past 1, 3, 5, and 20 years, even surpassing returns for the S&P 500 during that period. And if you look at the chart ahead of you, over the past 20 years, the MSCI India has compounded capital at 12.3% in US dollars compared to the S&P at about 10.7%. So that's 165 basis points of excess returns over the S&P 500 and, very comfortably sort of beaten the other global indices, whether it's MSCI EM or ACWI, the All Country World Index. And you see a lot of green in the cells out there that reflects the excess performance for India. So translating the power of compounding into dollar numbers, this chart is sort of simple, pretty self-explanatory, where if you invested $10,000 in India 20 years ago, that amount today is about $100,000 plus dollars compared to the S&P 500 at 75,000 and EM at 40,000. So investors have generated 2.5 times their initial investment as excess returns over the S&P during that time period. So very attractive returns for those that have stayed invested, and we believe this is going to continue for reasons that we're going to talk about. So, if you're intrigued and impressed by the returns of the MSCI India, we hope you're going to be further impressed by our returns in the New Asia Fund. The India holdings within the Barron's New Asia Fund have comfortably outperformed the MSCI India index. As you can see, we've compounded capital at about 18% since inception, about 3+ years ago, compared to MSCI India at about 15%, and significantly outperformed our peer average as per Morningstar at about 11%. So this is what excites us, and one of the drivers for this outperformance really is the asset mispricing that we are seeing in the small and mid cap stocks in India, where there's limited sell side coverage, which is an opportunity for us to sort of leverage our deep relationships in the country and create the alpha over the index. So just a quick snapshot in India. I'm sure many of the audience already knows some of the basic facts, but we'll quickly go through them. And I really want to focus on the two key areas that excites us going forward. One is the productivity enhancing economic reforms Michael briefly talked about, as well as the geopolitical tailwinds. But quickly, the other four key points out here. As many know, India is the largest democracy in the world and also the most populous country, with a population of about 1.5 billion people. It overtook China last year. India is also India is positioned to be the fastest growing large economy in the world this year. It's a $4 trillion economy, roughly, that's growing about 6 to 8% in real terms and 8 to 10% in nominal terms. So this is sort of very exciting growth, and we're going to let you know why this is going to continue. Similar to the US, India is a domestic consumption story where in excess of 60% of GDP is sort of driven by domestic consumption. Very attractive demographics. The median age in India is about 30. GDP per capita today is about $2,700, which is where China was in 2007, 2008. So we've got a 15+ year runway of growth ahead, as India catches up to China in various metrics, and this is what excites us. We really think India is the next China, as it's also getting reflected in global indices, MSCI EM as well, and a lot of inflows into India dedicated strategies. As a matter of fact, India dedicated AUM today is larger than MSCI Asia ex Japan strategies, so that's pretty groundbreaking. There's also a very strong middle class in India. There are about 300 million plus Indians are in the middle class, and that's growing. So it's almost the population of the US. That's the middle class in India, which creates the consumption power, which is creating great bottoms-up opportunities for us as well. So let's do a deep dive into the economic reforms and the geopolitical tailwinds that is driving the investment case for India, really, relative to peers. I would say one of the most transformative tax legislations and reforms that have been implemented is the goods and services tax, which is really simplifying sort of the tax code. As you can see on the screen, there are 8+ different taxes that are now converged or merged into one GST tax. And what this is doing is it's leveling the playing field for organized and unorganized players, and driving, is really accelerating sort of formalization of the economy. And let me give you an example of what's playing out. In a pre-GST era, say about 2018, if a transaction was happening between an unorganized player that wasn't paying taxes with an organized, say, a public company or a corporate, that transaction was happening in cash, and there was a paper receipt, and there was no tax audit for that. In a post-GST era, the way it's designed is the corporate entity now collects a GST tax from its customer, and in order to get a tax credit, it needs an official bill of materials from its vendors. So all of a sudden, it became a sink or swim event for a lot of these unorganized vendors and suppliers. Either they digitized and formalized and came into the tax economy, or else they just lost market share and went out of business. So what this has done is it's sort of created about 6 million plus MSMEs and SMEs to enter the formal economy. And sort of the proof is in the pudding out here, where GST tax collections have doubled or almost doubled over the past 5 to 6 years, when the economy has grown about 40 to 50% in that period. So that's really great from a fiscal perspective for the government, where tax yields are going up, and that excess tax collections is being reallocated to productivity enhancing capex infrastructure, which is once again driving that high economic growth that I talked about. Another sort of groundbreaking reform that was implemented a few years ago is the PLI scheme. This is another tax legislation that was implemented to attract greenfield and brownfield manufacturing and global corporates to come set up shop in India. And sort of this is getting turbocharged with the sort of geopolitical environment that's evolving, rising tensions between US and China, where, if you're a corporate in the US or Europe, your board of directors today is giving you a wake-up call to think of a risk mitigation strategy. If, say 85 or 90% of your manufacturing today is in China, you really need to think about a supply chain diversification alternative. So this is really creating a lot of FDI coming into the country, which is projecting India into a virtuous investment cycle. Some of the other reforms I'll quickly mention a few is, India cut corporate tax rates from 35% to 25%. That's once again exciting from an investor perspective. And there are a few other reforms, such as the Real Estate Act, that's really improving corporate governance in the industry, as well as a lot of reforms in the power infrastructure place that's once again kickstarting this capex cycle that we're excited about.
I think I just want to interject one thing on that last slide, which is I think this slide really makes the point, for active management for an India strategy, and also kind of explains why we've been able to significantly outperform the India index. Because what's happening here is these reforms are driving consolidation and market share gains for the best managed, most efficient, and companies with leading corporate governance. So capital's moving their way, market consolidation, and earnings growth is far exceeding what elsewhere exists in the India economy, which gives us a huge advantage as active stock pickers.
Great point, Michael. Thanks for bringing it up. Another really exciting sort of thematic that's playing out in India is accelerating digitization. Think about India's digital ecosystem as just about inflecting, and it's probably 10 to 15 years behind that of China. So the success and the value creation that investors have seen, with the rise of Baba and Tencent in China, India's just beginning that journey. And one of the drivers of that is really driven by a couple of companies we actually own, called Reliance Jio and Bharti Airtel. That's really democratized high-speed mobile broadband data. ARPUs in India are about $2 to $3 per month, which is probably the lowest in the world. And what this is doing is it's really empowering more than 750 million Indians with a smartphone today. And, they're shopping online for the first time. They're ordering food online, and they're making digital payments. And I think digital payments is really exciting for us, just given, what's playing out with UPI, which is the United Payments Interface. It's really sort of a government-sponsored digital sort of infrastructure, sort of gateway, where payments are now virtually free. So, like in the US and other countries, merchants have to pay an MDR. In India, that MDR is virtually zero. So what this is doing is it's really accelerating the penetration of cashless payments, digitizing the economy. And, if you look at that chart out there, it's pretty staggering. Sort of digital payments over the past 5 years have ramped up 25x, yes, 25x. Where penetration levels, 5-6 years ago were about 5% of GDP, digital payments, and that today is about 85%. So what this is also doing is it's creating a multiplier effect. Just as an example, the local shopkeeper that's accepting digital payments, that data is now mapped, and that access is available to banks. For the first time, a bank or a financial institution can now, effectively underwrite loans to that small business owner or to the small shopkeeper, where historically, his cost of borrow was, 45%, 50%, or even 100%. Today, that cost of capital has come down to 20 to 22%, which is really empowering that small shopkeeper to go out, expand his business, hire more people, and create that multiplier effect. So that's really powerful from an economic standpoint. And once again, that's creating that multiplier effect, which, where we are participating from a stock perspective. A few other things noteworthy. It may come as a surprise to many, but India has the largest and the most sophisticated biometric ID program. It's called the Aadhaar, where over 1 billion Indians are digitally mapped. It's the equivalent of a social security number, where you're mapped, and if you want to take a credit card loan, if you want to do virtually anything, you need your Aadhaar card. So the government has that data, which is very helpful from a bank perspective, from a credit card, credit underwriting perspective, and various other end use cases. The other thing that's also happening is historically, when there were subsidies given to the vulnerable or the masses, that payment was given sort of to the local government officials, and then they were responsible to hand out cash to the most vulnerable.
Not the most efficient way to do it.
But because of Aadhaar and UPI, those payments are directly transferred to the bank accounts of millions of Indians. So what that has done is that it's really eliminated the leakage, and that capital is about 35 billion of capital sort of subsidies are going directly to the end consumer, which is also once again powering the economy on the bottom end. So that's digitization, creating a lot of bottoms-up opportunities. And last but not the least, before we get into sort of where we're finding opportunities for stocks, geopolitical tailwinds. I think we cannot emphasize more on how important and crucial investing is becoming, taking a geopolitical lens. So in our view, India is a key beneficiary of the sort of tectonic shifts in the geopolitical landscape, especially in the aftermath of the Ukraine war and rising tensions between the US and China. And India is a natural ally to the West. It's the largest English-speaking democracy with strengthening economic and military ties with the West and the US. And if you really think about how the US is sort of evaluating its relationship with India, it's really a strategic counterbalance to a rising China, from a geopolitical standpoint. So it's advantage India from our perspective, and it's creating significant opportunities in terms of supply chain diversification. And a good example to give you is what's playing out with Apple and its ecosystem in India. So if we went back 3 or 4 years ago, Apple was producing about 2% of their iPhones in India. That number last year was 7%. This year is going to be 14%. And next year is going to be 25 to 30%. So we are clearly seeing a lot of interest for global corporates to create supply chain diversification strategies, to set up shop in India, not only for an export perspective, but also a very strong local demand perspective. And this is just one example to give, and we're seeing a lot of great opportunities there as well. Quickly moving on to our last slide before I open it up for Q&A. Where do we find opportunities from a bottoms-up perspective? So we've summarized the opportunity set in 5 key themes. Number one is digitization. We talked about that, where we are seeing the emergence of dominant sort of giants within food tech, fintech, e-commerce. Some of the names I mentioned briefly was Reliance Jio, Bharti, that are really the bedrock foundation of digitization in India. And then we've got Zomato, that's a leading food delivery and quick commerce player. It's been a great stock for us, and we believe it's going to be a $100 billion business over the next 5+ years. Consumer lending, also very exciting, just given consumer debt as a percentage of GDP is very low in India, and India's consumption journey is just getting started. The rising disposable income and the rising middle class. So we believe well-managed private sector financial institutions like a Bajaj Finance or an HDFC Bank, are well-positioned to gain market share and grow in excess of mid-teens to even up to 25% in the case of Bajaj over the next 5-10 years and even longer, just given where penetration levels are today. Another exciting theme for us is the financialization of savings. There's a structural shift of household savings in India from gold and real estate into financial products and services, equities, mutual funds, life insurance, savings products. And India's journey is just getting started. To share a data point out here, equity ownership as a percentage of GDP in India is about high single digit, maybe about 10%. And that number was similar in the US in the early 1980s. And we've seen, the value creation in the equity markets in the US over the past 40 years. India's just getting started. So we are really excited about the financialization of savings. It's been a great value creator for us, both in the EM strategy as well as the India Fund, New Asia Legacy. And companies like an SBI Life, which is the largest private sector life insurer in India. 361 is the largest wealth manager, like the Charles Schwab equivalent. We're seeing great opportunities there. Quickly on global security, which is really supply chain diversification. We've talked about it. Companies like Dixon Technologies, that is the largest mobile assembly player. A lot of businesses moving into India in terms of manufacturing of cell phones, smartphones. So Dixon's a key beneficiary there. And Keynes Technology, which is really a mission-critical supplier of electronic components to EVs, medical devices, defense, and autos as well. So really exciting opportunities in this area, and we've got a few more investments there. And last but not the least, the formalization of the economy. I'd mentioned GST. That's really sort of driving market share gains for the branded, well-managed, organized players, which are sort of gaining market share really quickly. And some of the names are Trent Industries. That's probably been one of our best stocks in terms of IRR over the past 15 months since we've owned it. We've probably made 4 times the money there. And Tata Consumer and Titan as well. So I'll stop there. I mean, that was our presentation. We'll open up for Q&A. Just want to rehash. We're really excited about the India opportunity. We do believe we are in the first or second innings of India becoming a dedicated asset class, just given all the reasons we mentioned. And we're excited about the new product, Better in India. We'll open up for Q&A now.
Great. Thanks, Anuj, for all that great information. Thank you, Michael. Let's see. We have a bunch of questions in the queue. There's a few about valuations. Maybe you could touch on equity valuations in India. Sometimes a premium, often a premium to their EM peers.
That's always question
Yeah,
number one.
that's always question number one. That's probably the most asked question. So the way we answer it is, a couple of ways. Number one, you have to distinguish between or differentiate between valuation and value creation. And valuation comes with value creation. So this is what the India story is. The visibility and durability of earnings growth that you get in India is unparalleled, across what we see in emerging markets or other parts of the world. And this is what you pay for, right? I mean, and there's a reason why it's been a top performing market in the world over the long term and short and medium term. Secondly, we believe that India is an alpha market where, there are a lot of asset mispricings, like I'd mentioned. And this is what we do. We focus on bottoms up opportunities which are mispriced, which we believe can, double or triple, over the 4 to 5 year period. And we've done it as you've seen in our performance. So that's what sort of investors should think about, the massive alpha opportunity with relatively lower risk. I may have mentioned it, but India's beta compared to MSCI EM is 0.5. So you're taking lower risk with higher alpha opportunity. So that's how I would answer it.
Just to bring that to life, I mean, maybe walk through when you first started working on Trent. I think you told me it looked on the headline like it was maybe nearly 100 times earnings, but then when you dug in and you saw the difference between your expectation of the next few years of earnings versus the market, it became all of a sudden much more much cheaper.
Absolutely. So I think this is also the difference between an index, passive index versus active management, where we can identify the mispricing, do the bottoms up work, and build conviction to create alpha. So with Trent, Michael, as you know, when we spoke to industry experts, we spoke to competitors, we really tried to size the opportunity set, and it was a big disparity versus what sell side was communicating.
Just to frame it, like, just to introduce you would think of it as the Zara,
Zara, yeah,
the
sorry,
Zara
I mean,
of India, just so our
Yeah,
listeners.
so maybe I should have started
yeah,
that. Sorry,
yeah.
thanks for that. So Trent think of it, Trent, as the Zara of India. It's a key. It's the leading fashion brand in India. As a matter of fact, Trent has a 50-50 JV with Zara in India, and the learnings that they've got from that partnership, they've sort of deployed into their own sort of brands, and they don't compete. They're different price segments. Trent is more value. So what Trent has, just so from that perspective, what we try to do is to really sort of map the opportunity set. And as just to give you a lay of the land, about 75 to 80% plus of India's fashion retail market is unbranded. So Trent plays beautifully into our formalization theme, where the aspirational middle class wants better quality, and they're willing to pay slightly more, for that quality, right, and the service. And when we looked at Trent, they had about 350 stores. Zudio is their format, is their brand. And when we spoke to all our experts, they were saying that 1,000 plus stores is almost a given over the next 4 to 5 years. And no reason why they cannot grow 150, 200 stores per year. And when we were looking at sell side, they were discounting, or they were sort of formulating only 50 to 60 stores into their models. So we thought this to be a huge mispricing. Also optically, they have a very exciting business called Star Bazaar, which is a leading supermarket chain in India. And that's a 50-50 JV, which is still loss-making, but is growing, rapidly. So optically, it was loss-making, and the markets were assuming it's so expensive on a PE basis. But when you actually separately value that business, it was screaming cheap. And that's one of the reasons why, when we started buying it at 1,500 rupees per share, we saw value, and today it's trading in excess of 7,000.
Wow. You laid out the growth story very well, Anush. Thank you. Obviously, it's been a great performer, India. What are some of the risks, though, go forward to the performance or that growth story?
Yeah. So, obviously, we debate that internally and think about what could go wrong. I mean, that's what good managers should do. From our perspective, I think it would be more of an external factor, just given the reforms domestically, the consumption are all sort of in a sweet spot. A lot of tailwinds there. India is an importer of oil. About 85% of oil is important. So if there's any sort of geopolitical or external factors where oil goes from $75 today to $140, $150, that's going to create a fiscal drag and obviously a consumption slowdown. If that happens. Secondly, just given the geopolitics that are playing out, if there are any disruptions in trade, we saw that with the Red Sea, COVID, that could impact sort of near-term visibility, I would say, for growth for some of our businesses. So I would say it's more centered around external factors. We feel very confident on the domestic
Even there,
trajectory.
I should point out that going back 4 or 5 years ago, India's Achilles heel was always this kind of budget deficit and trade deficit, being short oil. But what we've seen really in the changing geopolitical environment, which we talked about, post Russia invasion of Ukraine, this wall of money coming in for FDI is really reducing the vulnerability of India from that balance of payment perspective. So you're now seeing, I think the number is about a 4x increase in foreign direct investment that's coming into India, committed for the next several years, that was not there prior to that, this sort of supply chain diversification, manufacturing diversification that we're seeing moving in India's direction. So even that is de-risking, versus the way historically investors have thought about India, which we don't really think is appreciated enough yet by the global investment community.
Absolutely, Michael. You very well said. And also, just to give perspective, I want to go back to the Apple example, where it's now getting manufactured in India, which is once again a dollar inflow for the country. So once again, great for the currency, great for sort of supply chain diversification if you're the corporate like Apple. So it's sort of a win-win doing business in India to diversify away from China and maybe other parts that are not as friendly.
We did get a couple of questions just since we're talking about that, about whether you factor in at all the China-Taiwan risk and also Russia's relationship with India.
Sure, yeah. So the Russia relationship is a legacy relationship. If you go back 70 years, post 1950, that was the relationship where, India was getting supported by Russia in the geopolitical theater, and Pakistan was getting supported by the US. Clearly, a lot has changed over the last 70 years, and I would say even more over the past 5 to 7 years, where India has increasingly pivoted towards the West, just given what's playing out with China and Russia's growing relationship with China. So, if you're India and you're US, you see, it's pretty evident that it's important that India aligns more with the West, given the strengthening ties Russia versus China. And as a matter of fact, historically, India's been reliant from a military perspective on Russia, and that number was about 70 to 80% 5 years ago. Today, that number is about 30 to 40%. And the incremental share of defense is coming from Israel, is coming from France, Europe, and the US. So clearly, that's very encouraging, where increasingly India is sort of weeding away from Russia, just given changes in geopolitics, and closer to the US.
I think also on that point, some of the more recent sort of rhetoric about Russia-India relations is really about oil sales from Russia to India. And I think it's important to point out, after the Russia-Ukraine, conflict, if nobody bought that excess oil from Russia, there's going to be a huge increase in oil prices worldwide, and the U.S. is exposed to that. So the Western allies of India and the U.S. have kind of looked the other way and allowed India to be the big beneficiary of buying Russian oil at a discount, because that has become their ally. And a stronger India that can develop and help them, build this longer-term safeguard against, as this counterweight to China's influence, it's in the U.S. and Western interests for India. I mean, Western countries have, kind of clearly stated they won't buy Russian oil, but they're kind of looking the other way and allowing India to benefit. So that's another kind of positive from our perspective.
Definitely. Thanks, guys. And talking about some other external factors, we had a question about what if the U.S. were to go into recession? How might that impact the India story?
Sure. I think one of the reasons why India is such a big overweight for us in the EM strategy as well is that India is relatively sort of protected, given it's a domestic economy, less trade sensitive like a Korea or Taiwan or even China, as a matter of fact. So that gives us comfort that if the US does go into a recession, India, at least on relative, will be probably the least impacted of all the EM countries that we invest in. The sort of the reforms that are playing out, these are multi-year opportunities, and we are unlikely to see a significant slowdown in growth. As a matter of fact, last year, India grew 8%. This year, it's supposed to grow about 7.2%. So we believe that 6 to 8% growth trajectory will continue.
That's real growth.
That's real growth, yes. Real growth.
Nominal growth is low double digit.
Low double digit. So we believe that will continue to grow. Maybe it goes to 6% in the U.S. recession, but it's unlikely going lower, just given it's a bottoms-up local demand opportunity.
And we had a question about the U.S. election, and could that impact where the opportunity lies in India?
So unlikely any changes. If you see over the past 8 odd years, we've had a Trump regime, Trump presidency, as well as a Biden presidency, and it's worked out well for both. I think the bigger point is what we talked about, the growing strategic relationship, both economic and military, with India. So the focus is more on China in terms of that angle, and so India plays nicely into strengthening ties with the U.S. and Europe.
That's kind of was one of the catalysts, because India's beta wasn't always 0.5. It's been coming down for all of these reasons, and so that's what's kind of allowed us to have that much more comfort in having the large overweight and in launching a dedicated product.
And Dave, one more point we should have elaborated is what's playing out with financialization of savings. The equity ownership is low today, but what is also happening is significant retail participation. So retail inflows, which is the 401k equivalent in India today, is about 3 billion of monthly sticky inflows coming in. That number was less than $1 billion 4 or 5 years ago. And that's really creating a backstop for the markets, where if there's any sort of selling pressure from foreign institutions, the local investors are flush with capital, just given the financialization that's playing out, which is really backstopping the markets, lowering the beta, as Michael said, which gives us a lot of comfort that the flows story in India is just getting started, which protects downside in a way.
No, that's great. Thank you for that. And had a couple of questions about basically, can you discuss a stock idea that you're really excited about?
Sure. I briefly mentioned Keynes Technology. It's been a great stock for us. I think we've probably almost doubled our money. Michael, we invested
6 months or so.
we invested about last year, maybe November, December, and we've almost doubled our money there. So Keynes plays beautifully into the supply chain diversification, import substitution narrative theme that we have. Keynes is, when we invested, it was probably a $2 billion market cap company, and they are a leading sort of supplier, as I'd mentioned, mission critical electronic components that go into EVs, autos, medical devices. So in the aftermath of COVID, where there was big supply disruptions, that was a big drive for, local corporates to start sourcing locally. On top of which, the government, pretty smart with the PLI schemes that incentivized a lot of local manufacturing at very attractive return on capital thresholds with the tax subsidies. That really sort of created this lift off, this escape velocity in terms of local supply chains. And Keynes has been a key beneficiary. So to give you some perspective, Dave, Keynes, last year they had about a revenue of about $200 million. And they expect that to go to $1 billion in the next 4 years. So we are seeing 45-50% growth, off of small base, and this is just going to continue, right? This could be a $2-3 billion opportunity over the next 10 plus years.
I think also, just adding appeal. I think we've all seen how semiconductor industry is looking to diversify away from, say, Taiwan or even China. Apple moving the supply chain to India. India is really, at the early stages of trying to attract, a world-class semiconductor manufacturing sort of, industry. And you're really in the early stages. And Keynes, that's not really even in the numbers today. That's all upside, over the next 4 or 5 years as that develops.
So this business this year is going to grow about 60-65%. Over the next 3 to 5 years, more like 40-45% CAGR.
Well, that's great, guys. I think with that, we're probably going to wrap it up there. But I want to thank you, Anuj, and thank you, Michael.
Yep,
and most of all, I want to thank our audience for joining us today and for investing with us. And you will be pushed a survey. If you could complete that, we really appreciate your feedback. You can go to barroncapitalgroup.com to get a replay in a couple of days that will include the slides. And with that, that concludes our webinar today. Thank you again. Have a good day.
Thank you.
Thank you.